To you live. Crazy week. I loved the short week. I loved having that time off on Monday. However, holy smokes, a short week in a market that is as hot and volatile as what we're dealing with right now makes it a little bit challenging to put these things together. Find all the time to do it, but I'm here live at 3 o'clock on a Thursday, so I want to get right into it as quickly as I possibly can. And going live. Hang on just a second. So hope everybody had a fantastic Memorial Day weekend. We certainly did. And my hat's off to all the veterans out there, everybody that has fought for our country and has sacrificed their lives for our country. I forgot to say that last Friday, but I just wanted to say how wonderful it is that we have men and women of our country that fight for us and keep these freedoms going. So anyway, just wanted to start this presentation as fast as I possibly can. Let's see, go ahead. And here we go. All right. So, all righty. So, Stephen Thomas, Reports on Housing. I'd like for you guys to like and subscribe. Go to Reports on Housing on YouTube. That's would really help out. The more people that we get to see these videos, the more that we can properly set expectations of buyers and sellers and the general public, because there's so much misinformation out there. So please smash that like button and subscribe to our channel. We'd really appreciate it. And let's see. All right. Of course, we're going to start off with something funny. That's what we always do. This is actually a high school prank. This was they're the tornadoes, and I thought this was pretty fun. For sale, tornado real estate, 0 bedrooms. How many baths? 61 baths and 1,750 students. That's a great prank. And it sold instantly above asking. So the joke is on the kids. Real estate is like dating. The longer you're on the market, the more people wonder, what's wrong with you? This is exactly why you don't want to overprice your property. This is my Steinwriter for all of the sellers coming, and not all of them, but a lot of sellers this year are going to be overpriced. They're not going to get away with it. As we can see, we're already getting a buildup in the inventory. Housing insanity is definitely coming to an end. I talked about something similar a few weeks ago, but I definitely want to drill this point further, because we are seeing this shift really take hold now that we're running into the summer market. We're moving from an extremely rapid, hot, insane market, and it is shifting. And it's shifting to like a regular normal market. And people just aren't used to normal markets. As a matter of fact, I'm getting phone calls from agents out there that have been on the market for 3 weeks wondering what's wrong with them. And it's called, we're moving more towards normal. That's really what it is. The more challenging properties that are to sell, the longer it's going to take to sell. You just have to stick with the price on many of those. However, there are a lot of people that are overpricing, and that is resulting in accumulation of properties on the market. And you can see it here. This is the number of available homes, how it rises. This is 2013. It's the green solid line. The dotted line is the mortgage rates in 2013. Similarly, this year, that yellow gold line, we've seen this spike in rates, and we've also started to see a spike in the inventory. The inventory is growing at an extremely rapid rate. And it's actually surprising how fast it's coming up, because we're making our way towards that 25,000 mark, which is where we were back in 2013 when I said that was the most ridiculous market. We haven't even made it back to 25,000, but we're getting there, and we should be there within the next about probably month. We'll get to about 25,000 homes, and we'll continue to build from there. And what's happening is we're seeing this rise in inventory because of the rise in mortgage rates. And we could see the rise in mortgage rates. I wanted to first point out that recently we saw it right now, today, we have mortgage rates at 5.45%. This is on Mortgage News Daily. this is putting less down and not paying as many points. And that's more of an atypical buyer. And we're looking at 5.45%. And what we've seen is that they were as high as 5.65%, 5.64%, and then they came down. Last week on Thursday and Friday, we were at 5.25%. Then along came Monday, and we're already at Thursday, and you can see there's been a bit of a jump. It went up to 5.45%. Went down from yesterday just slightly, but it's definitely up from where we were last week, which means that we found a range. This range this year is between about 5 and 6%, and I think it's gonna have a hard time floating that much above 5.5%. We could get something that gets as high towards 6%. We might see some movement where it gets down below 5.25%, more towards 5%. But I think that's the kind of range now that the market has digested everything that the Fed is doing. Unless the Fed starts speaking a little bit differently, what we call Fed speak, they're going to, if they start talking differently, then we can get a further change in rates. But pretty much the higher rates are absorbed, and we're going to see that they stay in this channel right now, even as the Federal Reserve increases the short-term rate later this month and then next month, probably by 0.5% both times. That does not mean that we're going to get interest rates that go up a whole percent. Matter of fact, interest rates have already absorbed these changes, so we're probably not going to see much of any kind of a change in mortgage rate land. And you can see this is the spike at the beginning of this year, at the 5.45% that I was just talking about. The last time we were here was June of 2009. And we've been dancing between 2009 numbers to 2010. That's where we are right now. So it all predates this run-up that started in 2012 of our housing market coming out of the Great Recession. Demand, there's definitely a red flag. I've done it county by county by county, and I just did a report based upon that. And yeah, things are a little bit unaffordable out there, and it's because of the change in interest rates. When you go from 3% to 5%, there's definitely going to be an impact on affordability. And you can see it in demand as demand has absorbed these higher rates. Demand last week was at 14,904. That's 2% less, or 284 fewer pending sales. And remember, this is just a snapshot of the last 30 days worth of pending sales. And so that was last week at 14, just diving under 15,000. Last year at this time, we were at just about 20,000 pending sales. So you could see quite a bit different, 33% more last year, nearly 5,000 extra pending sales for all of Southern California. The 3-year average is 17,782, which is 19% higher than where we are, and 2,878 more pending sales. And that 3-year average is 2017, 18, and 19. I'm taking a look at that because that predates the pandemic, and that's more when we were dealing with more of a normal market for real estate. It's the lowest level since tracking began for this time of the year, even is lower than 2020, because it was, you could see that V-shaped green curve. It was starting to go up because pending sales were rising at a very, very rapid rate. Oh, excuse me really quick. How annoying. So today we're at 14,477. So it's actually gone down by 3%, or 427 fewer pending sales. And so if you look at the impact on rising rates, you can see this is where it shows it probably the best. At the beginning of the year, we had right around 3% mortgages, $4,000 a month desired mortgage payment. And you were looking at, if you're 10% down, you're looking at about a $1,054,000 house. Flash forward to today, and you can see we're between 5 and 5.5. So you're probably looking at about an $800,000 house. So really, you've come down at about $250,000 in purchase power. So you're able to purchase a lot less of a home if you're looking for that desired monthly payment. So payments is really the bottom line. Payments is what is really sucking the life out of demand. And now we have a lot fewer buyers in the marketplace that simply cannot play based upon where the mortgage rates are today. It just doesn't fit their budget. So as a result, we're seeing the supply of homes rise. So what happens is demand falls, and then because demand is falling, not as many homeowners are successful immediately, and demand starts to rise. And I talked about before, on the backs of dogs, on the properties that look like a dog, it should be priced like a dog. Properties that have inferior locations should be priced like they have an inferior location, and properties should not be overpriced, like being overzealous, like so many homeowners can be, adding a little bit of cushion. That is how we build this inventory, and we've seen the inventory build, and it's been building at a really rapid rate. And this all has to do with the fact that demand has diminished. And last week we're at 20,827. That's 10% higher, or 1,851 additional homes in a 2-week period of time. It's the highest level since December of 2020. So we're actually beat all of last year. That's the red line. So this beats all of 2021. We're at a higher inventory level than all of last year. And it dates back to, like I said, December 2020. Last year at this time, we were at 16,739, which is 20% less, or 4,088 homes less. The 3-year average is 38,677. That is 86% higher than where we are today. And remember, prior to COVID, 2017, 18, 19, it was still a seller's market. It was just about a 5% appreciation versus this 20% appreciation that we had. Matter of fact, we had Case-Shiller came out this last week. For the country, it's at 20.5%. That's how much appreciation. It's an all-time record for the United States, and that takes into consideration January, February, and March. And then today we're at 21,843. So again, we've climbed in just 1 week an additional 5%. So we're making our way towards 22,000 homes. Like I said, we're really quickly making our way towards 25,000, which is where we were in 2013 when things were extremely insane back then. So, but we are definitely rising. As a matter of fact, this is what it's going to look like. We're going to continue to rise. And then the peak, it typically happens in the summer. This year, it's going to happen during the fall, between October and Thanksgiving. And we will peak and probably surpass where we were in 2019. Because at the end of 2019, it was an extremely hot market. So we really ate away in the inventory, but it always falls into the year. So after we peak between October and Thanksgiving, the inventory will fall. And why will it fall? Not because there's a lot of success. There will be a lot of homeowners that actually pull their homes off the market to enjoy the holidays. At the same time that fewer homes come on the market in November and December. Those are the slowest times of the year for homes coming on the market. Now, this is across the United States. I brought this last week, and each week, this is Altos research, they've shown that the price reductions are increasing. Now, normally we have about 30% price reductions at this time of the year. We're right now at 23%. So it is definitely shy of where it normally is, but it's making our way up towards that norm at a very rapid pace as well. Because you could see last May, 2021, the frenzy was at 15.8%. So only 15.8% of the entire housing inventory at the time had reduced their selling price. They didn't have to reduce their selling price. Only the people that were extremely overzealous. So and this is where we are right now at 23.1%. And Los Angeles is at 23% of the entire inventory has reduced their price. Orange County is at 24%. Riverside's at 28%. San Bernardino's at 28%. San Diego's at 23%. So you can see Riverside and San Bernardino actually are knocking on the door of where the normal we normally have price reductions at this time of the year. So that's actually fairly good news for the whole marketplace, as we see a more normalization as far as more price reductions coming. And why are price reductions coming? Because of overpriced properties. And you can see also here, this is the number of immediate sales. Altos Research actually tracks the number of immediate sales. And at the start of this year, it was like a record territory. You can see December 2021 and even in January, February, it was pretty crazy how elevated it is. However, it has been plunging since the end of April, and now only 23% of new listings went into contract immediately within the like the first week. So that is a big change. It's a welcome change, and as you can see, we'll be continuing to track this with Altos Research. They've been doing a great job out there. And then I just want you to understand what we're trying to get towards. Remember how I said we're trying to get to the normal, the average between 2017 and 2019? That normal, if I take my mouse, it's right over here, is 2017 to 2019. That was the normal level where we were still getting appreciation across the country. In Southern California, appreciation was about 5% per year. And if you see way over here, those are those Himalayas in the middle. Those Himalayas, and this is courtesy of National Association of Realtors, Trading Economics put this thing together, but you can see that there was actually the Himalayas, and that was the Great Recession. Now, what this represents is where we are today is we only have 1 million homes on the market. That's it, just 1 million homes on the market. Now, it was even shy of 2 million homes, 2017, 18, and 19. But you could see 2 million is what I like to see us get towards 1.5 to 1.75 million. Now, where were we during the prior to the Great Recession and during the Great Recession? 4 million homes on the market. So that is what we refer to as a supply glut versus the lack of supply, the supply catastrophe that we're dealing with right now. And so I'd like to thank our sponsor. We have a brand new sponsor. It's Jason Thibodeau from JMJ Financial. You can contact Jason at 714-330-8263. He's with the Thibodeau and Morel Group at JMJ Financial. And they have this earnest money deposit insurance program. It's called a homebuyer EMD protection. So that's when you have to do a few things beforehand, but they'll guarantee up to $50,000 of your earnest money deposit if something happens in the transaction. They can explain more, but that's pretty fantastic to be able to secure your earnest money deposit. They also have a lock and shop mortgage, remove the risk of rising rates while house hunting. Their lock and shop options provide a great opportunity for qualified buyers to lock in their interest rate prior to choosing their home. That is what you kind of need to do in this volatile kind of market, and you can definitely talk to the group, and they will definitely tell you exactly when they most likely think you should lock. But I'm thinking that interest rates could go a little bit higher. We'll just have to wait and see if there's another one of those lows where we get back down towards 5.25%. But that, like I said, we're going to be ranging between 5 and 6% this year. So please give Jason Thibodeau a call at JMJ Financial. He's with the JMJ Financial, the Thibodeau Morel Group. You can contact him at 714-330-8263. That's 714-330-8263. And thanks for your brand new sponsorship, Jason. So how fast is this market moving? It's moving pretty darn fast, and it's still fast, even though it is in the process of slowing. So understand that on March 17th, we were at a 24-day expected market time, which is absolutely insane. Anything below 60 is considered a hot seller's market, and the lower you get, the hotter the market. And actually, a seller's market goes anything under 90 days. So you can understand that at 24 days, it's absolutely insane. You can understand why values were going up so fast. Last week, we were at 42 days. Last year at this time, we were at 25 days. The 3-year average is 66 days. But now, interesting is today we're at 45 days. 45 days is definitely a slowdown from where we were at in March at 24 days. That is, it's taking an extra 3 weeks to sell homes. And people are feeling it out there. So the market is on from absolutely insane, and that's anything below 40 days is insane. It's just nutty, and it's beginning to diminish. And I know there's plenty of people that are talking about, oh, well, my house still sold instantly. There's still going to be froth in the market, but the froth too is going to disappear. So those agents that think and homeowners and people out there that think that their homes are going to sell instantly, that is going to go away the further we get along in this year. So it's going to be so important to price. appropriately according to the comps. And the expected market time in Los Angeles has gone March 17th today, 30 to 47 days. So we're at 47 days in LA, not insane. Orange County from 20 to 41 days. For the first time in a long time, Orange County is no longer insane. Riverside is also at 43 days, went from 21 to 43. No longer insane. San Bernardino from 28 to 55 days. Matter of fact, they're actually approaching 60 days. If they get above 60 days, that means San Bernardino will slow down to where there won't be as much appreciation in San Bernardino if this continues. And San Diego went from 18 to 38 days. So they're technically still insane. I imagine by next week, they will leave the insanity column and they too will be at 40 days or higher. So, but I want everybody to understand that I am not talking that the market is slowing down and turning into a buyer's market. The market is trying to move towards balance. It's trying to move its way towards balance. And that's just that's what it is. It's just because it isn't a seller's market doesn't make it a buyer's market. It means it's a more balanced market where kumbaya, everybody gets together and gets along and tries to put together transactions. It doesn't favor either buyers or sellers. And one last thing I wanted to bring you was the real-time SOM rule recession indicator. Now, this gal is now on the Fed's website, and that's because she has proven that she can tell anybody when we're in the midst of a recession. And she's been right, and she went back all the way in time to show every single recession that she has all the metrics to show when we're in a recession exactly while we're in it, rather than waiting for somebody down the road to say, okay, we were in a recession. So this index right now, as you can see on the right-hand side, is showing, and when this is close to zero, it means that it's not showing recession, and that is exactly what it is, not showing recession. So, and one question that Shan has is, how would you classify a market as a buyer's market? You classify a market as a buyer's market. It's not once you get above a seller's market, that's 90. It goes from 90 to 120 days is actually equilibrium, and that's a balanced market. Above 120 is a slight buyer's market, and above 150-day expected market time, that is considered a deep buyer's market. We're nowhere close when we're dancing around 40-day expected market time. It's just we're moving towards balance. So, and do not expect a buyer's market anytime soon. And so if you want a copy of this, you need to be a subscriber, because subscribers automatically receive a copy of this. And you can go to reportsonhousing.com, click on subscribe, and we have reports that got all over Southern California. LA, Orange County, Riverside just got theirs. And it's all about affordability. And then Riverside and San Bernardino will get theirs next week. So we're talking all about affordability and drilling down to each individual county, showing why the market is slowing based upon affordability. And coming soon is the Bay Area. So subscribe, and it's $15 per month, $150 per year. The first month is free if you utilize the coupon Not Insane. And that's not the Sky is Falling was the one from that San Bernardino Riverside got last week, and Orange County and LA got the week prior. It's the one on affordability that just came out this last week. Forgot to update that slide. So there's been new content that we put together. It's called The Scoop. You can get this for free. There's free content on our website. So go to reportsonhousing.com. You can see the Southern California report. Now, if you want to see what it looks like, you could test drive it, download it, and you can even post it to social media. And but if you want to customize county scoop report, you have to go to the website and click on, you can even view a sample report, but click on the individual county, put in your information, but you have to be a subscriber, and it's only $10 per month. And we will actually modify this thing and customize it for you. That's all I have for everybody, but I hope you guys have a fantastic finish to your week. I do have a couple of guests that I'm bringing live to you. Here's one of them. What's your name? Yeah. I thought you were going to wear a Batman costume. What happened? Maybe next week?
Maybe today.
Maybe today you'll wear a Batman costume?
Yeah, I'm going to today.
Okay, that's fantastic. That is so much fun. I love it when you wear that.
After it gets dark.
After it gets dark. After it gets dark, he becomes Batman. That's a good idea.
No, Batman comes to get darker. Darker, Batman comes.
Oh, yes. Batman comes when it gets darker and darker.
In nighttime, fairies come.
And fairies come at night. That's pretty awesome, Zeke. Say goodbye to everybody.
Bye.
And who else do we have? We have somebody that's brand new on summer break. Who's this?
Oh, hi.
Mason Edward, summer break. Boop, boop. Right here, buddy. Pound it. Who else is on summer break? Do I have any more special guests?
Let's go summer. Wait, today I have a track meet. Not today. This
Tomorrow.
weekend.
Right on. Boom. His track meet. Who else do we have here?
Hi,
Who's this?
Athena.
Right on. She is now officially a 7th grader, right?
Yep, 7th grade.
Right on.
My hair's
So-
a mess. It's so bad and
Wow.
atrocious.
Well, next time we need to definitely do some makeup and brush our hair before we go live on Facebook. and
makeup.
YouTube.
Who wears makeup?
Your sister.
You should show your natural beauty and show the whole world who you truly are.
Awesome. Appreciate it. Anyway, well, thank you so much for joining us on another edition of Housing Debrief. We will see you next week. Have a